This split-screen chart illustrates the central macroeconomic paradox of mid-2026. On the left, we see top-line equity markets demonstrating remarkable growth. But on the right, forward-looking indicators like the Conference Board's leading economic index show a potential deceleration in near-term activity. The market's resilience is incredibly concentrated. While the S&P 500 has surged over 25% since late 2024, the S&P Small Cap 600 remains weighted down by domestic inflation and acute supply chain disruptions. Beneath the surface of these high-performing tech conglomerates, the underlying macroeconomic indicators reveal escalating friction in the labor market and a steady climb in structural unemployment. The root cause is the systematic dismantling of the pre-2025 global trading consensus, replaced by an aggressive protectionist architecture. The administration's economics-first approach deliberately sacrifices the efficiency of the old global model for coerced domestic reshoring and hardline geopolitical leverage. For corporate treasurers and institutional allocators, this demands a new bedrock axiom: the era of optimizing for the lowest possible cost is over. Navigating the quarters ahead requires a nuanced understanding of this new tariff architecture, the fiscal restructuring driving it, and the emerging U.S. Japan energy alliance. For institutional capital to survive in 2026, it must shift its primary objective from cost efficiency to geopolitical resilience. In February 2026, the Supreme Court ruled that the administration's initial blanket tariffs were not legally authorized under emergency economic powers, effectively striking down the government's primary trade war mechanism. The administration executed an immediate pivot, invoking Section 122 of the Trade Act of 1974 to apply a 10% universal tariff to nearly all nations. This move targets an estimated $1.2 trillion of annual imports, representing 34% of total inbound trade. This trade wall is being actively weaponized for diplomatic leverage. Brazil, for instance, faces a punitive 50% tariff driven by political friction. Rather than reshoring to the U.S., many supply chains are migrating to diversification hubs, attempting to route goods through third-party countries to bypass these walls. To combat this, the U.S. implemented a 40% anti-circumvention tariff, specifically on goods transshipped through Vietnam, forcing a more aggressive industrial divorce. Global supply chains are fracturing into high-cost, secure domestic hubs and complex, opaque secondary networks, trapping massive corporate capital reserves in the friction of continuous customs audits. On the domestic front, the One Big Beautiful Bill Act functions as a $4.5 trillion supply-side stimulus, even as the federal deficit is projected to remain above 6% of GDP through 2030. The distribution of these cuts is heavily concentrated. For example, the Section 199A pass-through deduction directs 87% of its benefits strictly to the top 10% of income earners. To partially offset the deficit, the legislation authorized profound reductions in the federal social safety net and systematically dismantled over $1 trillion in green technology incentives. Simultaneously, the Department of Government Efficiency, led by Elon Musk, was tasked with an unprecedented mandate to extract $2 trillion from the federal budget. By the time it disbanded, DOGE had eliminated over 200,000 federal jobs. However, the immediate firing of essential personnel degraded the fundamental operational capacity of critical agencies. This administrative austerity created secondary friction that directly impacted commerce. FAA labor shortages caused widespread commercial flight cancellations and severe delays in air freight logistics. The collision of massive deficit spending and administrative supply-side degradation sustains a persistent upward pressure on the core consumer inflation rate.
Because universal tariffs function as a regressive consumption tax, they directly add an estimated 0.5 to 0.7 percentage points to headline inflation. Smaller manufacturers are particularly exposed. Those importing over 20% of their electronic components are confronting a baseline cost increase of roughly 3.5%. The American agricultural sector has served as a primary collateral casualty, with retaliatory foreign tariffs obliterating export markets for soybeans, corn, and wheat. The administration attempted to pacify this constituency with over $30 billion in emergency assistance, such as the Farmer Bridge Payment Package. But this capital distribution was highly uneven. The vast majority of bailout funds were absorbed by corporate megafarms, accelerating the consolidation of rural land and the decline of independent family farms. These policies are fostering the rise of a permitted oligopoly. In this environment, only massive conglomerates possess the scale needed to absorb the systemic friction of custom audits and rising input costs. This chart highlights the extreme market concentration. Just 7 technology firms accounted for a staggering 55% of the S&P 500's total return, while small-cap equities managed almost no gain. The result is a profoundly uneven playing field, where sectors aligned with the administration's goals, like advanced nuclear and AI infrastructure, see government-subsidized expansion, while smaller enterprises struggle with margin compression. The administration's ultimate industrial goal is global supremacy in artificial intelligence, which it views as a challenge of electricity generation. This strategy required the systematic dismantling of environmental regulations, including the EPA's repeal of the 2009 greenhouse gas endangerment finding. This was followed by a staggering mandate from the Department of Energy to quadruple domestic nuclear output to 400 gigawatts by 2050. This voracious demand for baseload power catalyzed a profound commercial alliance between the United States and Japan, formalized in a $550 billion trade framework. Japan is executing a strategy of strategic indispensability. By investing hundreds of billions into U.S. energy, Tokyo is immunizing itself from future trade wars. This map shows the physical reality of that alliance. Advanced nuclear reactors and natural gas generation hubs linked directly to centralized AI compute clusters. The capital deployment is massive, including $40 billion for small modular reactors in the south and a $33 billion natural gas facility in Ohio. By embedding its corporate champions into the bedrock of U.S. critical infrastructure, Japan has made future punitive tariffs against its companies economically self-destructive for the United States. The collision of universal tariffs, heavy deficits, and administrative supply-side pressure establishes an operating environment characterized by high friction and structural inflation. Surviving this paradigm shift requires corporate leaders to pivot away from traditional cost-cutting models and move toward a strategy of geopolitical resilience. This begins with rigorous audits of harmonized tariff codes and customs bond coverage. In a world of individualized exemptions, companies must maintain the capital reserves needed to manage continuous supply chain oversight. Management must also look to the M&A market. The loosening of antitrust enforcement allows companies to acquire localized supply chains and manufacture their way out of tariff exposure. Finally, organizations must secure sovereign, dispatchable baseload power. As Japan's strategy shows, access to energy is now the fundamental constraint for capital deployed into compute-heavy ecosystems. The 2026 landscape represents a high-stakes generational gamble, an attempt to trade short-term administrative chaos for long-term strategic dominance. In this new paradigm, institutional survival depends on recognizing that physical control of supply chains and baseload energy now supersedes traditional financial modeling.